second part of the master of business trading. First thing by master of trading and trader. Now in this video we want to talk about, in practical sense, we want to illustrate and look at most of the things, or all of the things rather, the key concepts that we have discussed through the 40 days trading for dummies series. I do understand that for a lot of people, learning, to balance motivation of learning, you have to not just consume information, but in practical sense look at how this information that you are consuming can actually work in the market, in reality, in real life. So that is what I want to do. I have held over a 1-hour live session on TikTok where I have illustrated basically all of the topics that we have covered. Now in the next 30 minutes or more, I will try as much as I can to explain in details, in basics form, and in the most simplest form that I can, the key concepts that we have talked about through the Trading for Dummies video series. And the main focus of this Trading for Dummies series is, if you've been following through, it's market structure, supply and demand trading, and then we looked at some tools and indicators that you can use to better your trading. That is aside the other factors, the psychological, philosophical, mental other factors that was mentioned. Now I'm looking at, coming from the aspect of a technical analyst, looking purely at technical analysis, I want to look at the key concepts that we have talked about, because what I am trying to do with this video series is to bring to you concepts. It is the concept that I am trying to pass across. It is the concept that matters. Once you can grasp the concept well enough, you most likely don't even need it. You can go into the market and figure out a way to make it work for you, based on your personality, based on your person. So that's basically it. Now I'm going to center for the next 30 minutes, I'm going to center everything around this concept of price action, market structure, order blocks, and supply and demand trading, basically. So now when you open up your price chart, what you are going to find on your price chart are market movements in patterns and structures like this. But it is very important to understand that all of the information that is presented here are not just presented in entirety how it is looking right now. What we have here is one individual candlestick followed by another individual candlestick, followed by another individual candlestick, followed by another individual candlestick. And over an extended period of time, it begins to form up structures and patterns in the market, like you are currently seeing right now. So I am going to zoom out my chart. This chart I have right here is from TradingView, and you can access this strictly by you can download the TradingView app on your mobile phone, on your laptop, or you can basically use the web version, www.tradingview.com, and then before you know it, you find a page that is similar to what I have right here. Now I'm going to zoom this out. Let's look at the concept of candlestick analysis first. What exactly is a candlestick? And in the course of our trading series, we rightfully explained candlestick to be an illustration of price movement over a given period in time. So it can be a 1 minute candle, can be a 3 minute candle, a 5 minutes. It doesn't really matter. What candlestick shows is how price have moved over a given period of time. So if you're looking at a 1-hour candlestick, you are basically looking at price movements minute by minute, or basically if you're looking at a 1-hour candlestick, you are looking at 60 1 minute candlesticks, how they are formed up and moved in the market. Basically, that is what we are looking at. So I'm going to look at that. We said that the candlestick is defined by highs, lows, open, and close. What I have here is my candlesticks is in black and white. Usually you have candlesticks in green and red. Green usually indicating bullishness, while red usually indicating bearishness. Now in this case I have black to indicate bullish formations and white to indicate bearish formation. We are going to look at the open, close, high and lows of one bullish candle and one bearish candle right about now. So I'm going to let me pick out any random bearish candle here and any random bullish candle. I'm going to use this for bearish, for bullish, and I'll take this that we have right here. I would have loved this, but for a lot of people that are new to trading, because this doesn't have a wick, this is going to be a problem for most people. And very important, the components of the candlesticks are body and then wick. Let me illustrate that. Are body and then wick, like this. If you look at your price chart, you would likely find your candlesticks with these things that looks like lines shooting out of each of them like this. The body right here shows price movement from the opening price of that time period to the closing price of that time period, while the wick, these shadows that is shooting out of the candlestick, shows the highest point and the lowest point that price got to within the period of that price movement. So let's look at this as a bullish candle. We are going to take this to be the opening price of the bullish candle. If it is a 1 hour bullish candle, this is the price that the 1 hour price movement started, and then this is the price that the 1 hour price movement ended. So this is the open of the period, this is the close of the period. Now the high is the highest point that price got to, and usually you will find this as the wick of the candle. Now this is the high of the candle, while the low is the lowest point that price got to, which is here. Now in a split seconds, let us quickly look at this on the price chart. Okay, so on the price chart, as I said, we are going to take out one bullish candle and one bearish candle. I'll look at this as the bullish candle, and we have this price level right here to be the opening price of the period. This is a 30-minute period. This is 30-minute time frame. I'm looking at the 30-minute candlestick. So this is the price that the 30-minute candle opened at. This is the price that 30-minute bullish candle closed at, and then at some point within the 30 minutes, price got as high as this point before closing down here, and then at some point within the 30 minutes, price came this low before closing back up here. That is for the bullish case. Looking at this candle, this bullish candle we have right here, this bullish candle right here. Now let's flip it a bit. Let's look at in the bearish case, what is the open, high, close and low of the candlestick going to look at. And I said we are going to look at this candle, and the opening price is right here, is the price at which the 30-minute price movement started, and then we have this to be the low, the price at which the 30-minute period ended, and then we have this to be the high, which is the highest point that price got to within the 30 minutes up here, and then we have this to be the low, the lowest point that price got to within the 30 minutes that we are looking at here. So we've looked at a bullish case, and then in this case we are looking at a bearish case illustrating bullish candles and bearish candles right here. So that's basically it. Now it is very important to note that candlesticks represent price movement over a given period in time, and since price is a chronology, price is constantly moving forward, you are going to find your price charts constantly moving forward, forming structures and patterns in the market. Constantly you are going to find price moving forward. I don't want to go to the 1 second time frame. We best find out in 1 minute. You constantly find new candlesticks forming up from one price level onto another, from one price level onto another. Now, as price roll out based on how time unfolds, you will begin to find out that what you are seeing on your chart is no longer individual bullish candles or bearish candles. You begin to find structures, bullish structures or bearish structures forming out in the market. And a bullish structure is basically an uptrending market structure. A bullish structure is a market structure that shows price movement moving upward over a given period in time, while a bearish price action shows downward price movement over a given period in time. We are going to look at this quickly. Market structures can be classified into trends and range. I personally don't pay any emphasis on market range because my trading style, my trading system is fitted around trading trending markets. So for me, 90% of the time, the emphasis is on trending market. But for the purpose of this video, we are going to be doing quick illustration on both market trends as well as market range. Now, firstly, a market trend is, like I have stated earlier, is this market conditions where you can find market moving clearly in a direction, either in an upward direction or in a downward direction, but that is a market trend. And market trends are defined by impulse and correction, by highs and lows. These impulse and corrections are identified as highs and lows in the market. And the impulse is basically that point in your price chart where you have price moving strongly, very strongly in one direction, while the correction or the pullback is when after that strong direction movement in one direction, price pulls back slightly before continuing. We are going to look at each of that right about now. Now, in an uptrend, this impulse and correction are defined as higher lows and higher highs, while in a downtrend, this impulse and correction are defined as lower lows and lower highs. I will take each of these cases right about now. Now, what we have right here is the price chart for Bitcoin, the updated price chart for Bitcoin. I would look at everything that has happened from this point up until this point, which is basically looking at price movements from on Thursday, the 14th of August 2025, up until today, this very today, the 13th or 12th of September 2025. Now, if you look at price movement from this 14th of August up until this point, you find that Bitcoin have moved in downward direction in a downtrend, and then that's looking at this from a 30-minute time frame, and then it's recovering and now beginning to move in upward direction. Now, we said that the trend is defined by impulse and then correction. So I'll try to illustrate that. Impulse is where you have the stronger move in the direction of the trend. So in this case, we have a downtrend. You can see a very strong downtrending move up until this point before this this little pullback. This is a pullback and it is little because compared to the strength of this downward movement, this pullback is little compared to the strength of this. So this is the impulse, and then this is a correction, and then we have a continuation impulse, and then a correction, and then a continuation of that downtrend for an impulse, and then a correction. Now, something very important happen here. You will discover that what we would want to see usually, because this is a downtrend, you want to see market breaking previous lows for continuation of the downtrend. But price got to this point, peaked out, moved down like still moving in the continuation of the downtrend, and then bounced back up, broke above this high, confirming a change of character, and then before coming here, impulse, correction, impulse, and then I think we are heading for another correction right here. So basically, a trend is defined by impulse, which is the stronger move in the direction of the trend, and then correction, and then which is, you can have seen here, impulse and then correction, and then this is defined by highs and lows depending on the trend. So in an uptrend, I will take the uptrending case first before we go to the downtrending case. Now, in an uptrend, you can find that coming from a previous downtrend, this is the lower high of that previous downtrend. Now, usually we want to see price continuing in the downtrend, but price moved down to this point and then bounced and break up here. Now, in our trading for dummies series, we mentioned change of character and break of structure. Now, in the process of explaining this, I will touch the both of that very quickly. Now, price reversed from this downtrend, forming an uptrend. Now, this is the higher low of this uptrend because we have a previous low to the trend. Have a previous low, and since market is coming from a downtrend, we have a lower low. Now, market has failed to continue in the direction of that trend, forming a new low. But since this new low did not break below the previous low, it is defined as a higher low because it is a low, but it is not below the previous low of the trend. So it is higher than the previous low. So it is a higher low. This is what we have right here. Now, market broke above the previous lower high of the downtrend, and which is where this can be marked out as where we have our change of character. The change of character is basically that point where you have market breaking a previously established structure to start a new trend. So in this case, we have this level here previously established as the lower high of this downtrend, the previous downtrend we are coming from, and then price breaking above that lower high to form a higher high this time around for this uptrend. So this is the point, this point right here where we got this break of structure is where we have our change of character. Now, the change of character and the break of structure are particularly similar, except that the break of structure defines continuation of the trend, while the change of character defines the reversal of a trend, like in this case where we have a downtrend and then reversing into an uptrend. So this is the lower high of the trend, of this uptrend, and then here we have the higher high of the uptrend. Let me mark those out. Lower high, and higher high, and this is higher high because it broke above the previous high of the trend, which is this previously established structure we have right here. Now, and then we have this again, lower high right here, because price pulled back from this point but did not break below this point. So this is a low, this is the previous low, this is price not breaking below the previous low. So this is a higher low because it is a low that is higher than the previous price of this low. Simple. Now moving from here, we came here, a higher high, a higher low again, and then the continuation of the higher high. Impulse, correction, impulse, correction, impulse. That is how the uptrend is defined. Now we'll look at the previous downtrend quickly, and here you will find price. We had a previous uptrend. This is the higher high of the uptrend. Price breaking below that high, breaking below these internal structures, and then coming down to from here. Usually we would want to see price break, bouncing off from here, breaking up above here to continue this uptrend that we have. But since that did not happen, price pushed down, broke below this, making this the lower high of this downtrend. It is the lower high because we have the previous high of the trend, higher high, and then we have price breaking below this point. Since we've broken below this point, the new structure shows now that this is the high. Since this high is not higher, it's not above this previous high, it is a lower high. It is not above the previous high, so it is a lower high. So right here we have the lower high, and then price coming to break this. Now we have a break. Okay, this can be defined as a change of character because we are coming from a previous uptrend. I'll mark this out as the lower high. I'll bring this and mark this as the lower low, and then price bouncing back from here, pulling back to this point as still the lower high because this is a new high but did not go above this, so it is a lower high, and then breaking below here to this point. Now this is it. This is a change of character because this is a higher low to the previous trend. Market breaking the higher low of the previous trend to form a new trend. Now this is a break of structure because market breaking the new low to continue the trend, to continue the downtrend. So this is a break of structure for reversal of a trend. This is the break of structure for continuation of the trend. That is defining break of structures and change of characters. Now, since that is established, I would like us to quickly look at trend line support and resistance very quickly. Now, when a trend is moving, it moves in these patterns of highs and lows, and traders have defined a way for themselves of following these patterns by defining the trends in trend lines that serve as strategic support when price moves back towards the trend line in an uptrend, and as strategic resistance when price moves towards the trend line in a downtrend. Now, there are no grand rules for defining what a trend line should look like other than the fact that your trend line should be connecting highs and lows of the trend. So in a downtrend, your trend line should be connecting along lower highs of the trend, while in an uptrend, your trend line should be connecting higher lows of the trend. The stronger a trend line is tested and respected, the more a trend line is tested and respected, I think the stronger it is said to become. Okay, so right here I have a downtrending line, a downtrend line, and then here I have an uptrend line. And what you find traders do, traders that base their trading decision off these concepts of trend line, support or resistance is for every time the price move towards the trend line, they will be looking to either buy or sell. So in this case, we have an uptrend. If price pull back towards the trend line, a trend line trader will be looking to buy at this point, to buy at this point, to buy at this point, as well as if price comes back in the future towards this trend line, let's say like this, a trend line trader will still be looking to buy. Now, in the case of a downtrend, a trend line trader will be looking to sell whenever price approaches the trend line. So price got to this point, is looking to sell. Price gets to this point, is looking to sell. Price gets to this point, is looking to sell. Now, there's also another way that traders looks to trade trend lines, which is breakout trading. Basically, is the idea is that a trend is valid as it continues to respect the trend lines. But when the trend line gets broken, usually traders that base their decision on identifying these trend lines in the market would now be looking to reverse their trading decision. So breakout trading, basically, I think I have somewhere that this is very well illustrated, which is right here in this price chart. You would see that we have a downtrend line. Price broke above the trend line, came back to test it, and then moved in the direction of an uptrend. Now, for a breakout trader, he would be looking to buy either at the point where price broke above this downtrending line, or at the point where price comes back to retest this downtrending line. But breakout trading is basically, if markets goes out of a predefined range of highs or low, it doesn't really matter whether it is a trend line, a support, a resistance level, but there's a predefined level in the market. There's a predefined structure in the market. Whenever price breaks out of this predefined structure in the market, breakout traders want to look for ways to move in that direction with the market, thus defining the concept of breakout in trading. Basically, that is breakout trading. And why these trend lines can be used as strategic support and resistance. Traders also basically like to look at support and like to look at levels where markets find support and resistance in the price chart. So very quickly we'll look at support and resistance levels in the market and key takeaways when looking to trade the support and resistance level. So basically, resistance is price ceiling. Resistance is price ceiling, is that wall in the market that price almost gets rejected every single time that it tests that level in the market. So you have a barrier, a wall that price rallies into, get rejected, and then get pushed back down. That is resistance. While support is that place where, like the name implies, is that price level, that price range where buyers find support in the market, where price drop to and then begins to cool off and bounces off from. So on the price chart that is illustrated, you can find that these levels where you have multiple rejection in the market. In this, you can see price getting rejected here, getting rejected here, getting rejected here, moving towards that level, getting rejected here, getting rejected here, getting rejected here, before breaking out of this range. So this price level for support and resistance traders can be identified as a resistance level in the market. It is a market that poses a barrier to price movement, basically. And one very important thing when looking at support and resistance trading is that support and resistance is not a particular price level in the market. It is a price range in the market. It is not that there's a particular predefined price that, let's say, Bitcoin at $111,000 is resistance. Whenever price gets to $111,000 $111,000 is supposed to get rejected. No. when looking at support and resistance, look at it as an overall price range. Like in this case, you can see that price got rejected here, higher in the price range, here lower, here somewhat in between, somewhat in between, somewhat in between, but it is not a exact spot a price always gets rejected from. It is a range. It is a price level where buyers and sellers see value in the market, basically. Now for support, I'm going to mark out this range down here as support range, and you find price testing here as support, going back, coming here as support, going back, coming here as support, going back. Now one thing to take home is, for support and resistance trader, whenever a support and resistance level gets broken, it immediately flips row. So let's say in this case this is resistance, it has been broken, it flips row almost immediately. For a support and resistance trader, it becomes support. So when resistance gets broken, it becomes support. When support gets broken, it becomes resistance. And the more a support and resistance range or zone is tested and respected, the more it is assumed to be stronger. So the more it is tested and respected, it is assumed to be stronger. Yes, so that's basically to support and resistance. Now it is also very important that when looking at market analysis, when looking to analyze your price chart, time frame is very important. Time frame plays a very important role, because you can be looking at a particular price, you can be looking at a particular structure, a particular area of value, basically, that on a much bigger time frame isn't an area of value. And one thing for sure is, higher time frame trend, higher time frame structures, higher time frame levels, higher time frame zones are usually stronger and more significant than lower time frame structures in the market. So if you are looking at a smaller time frame demand, a smaller time frame bullish setup, and that bullish setup is sitting in a bigger time frame bearish setup, then it is more likely that the smaller time frame bullish setup will get invalidated, because it is not in correspondence with the higher time frame structures. So usually you want to align your smaller time frame buyers with higher time frame structures and buyers in the market, very importantly. Now, to look at multiple time frame analysis, I think the best way to approach multiple time frame analysis is by looking at market in smaller time frame structures and bigger time frame structures, internal and external structures. And basically, external structures are the overall swing structure of the time frame that you are looking at, the time frame that you are taking as your prevailing time frame. So right here I have the price chart for Bitcoin against the US dollar, and right now this price chart is on the 4 hours time frame. So I am looking at the 4 hours time frame as my biggest time frame right now for the purpose of this video and for the purpose of this analysis. If the 4 hours time frame is my biggest time frame, then the 4 hour structure is my external structure, is my swing structure, is my external structure. I'll look at this downtrend right here, and then if we would go down to a much smaller time frame and we begin to find structures in smaller time frame, that structures will be internal structure. And like stated earlier, why it is okay to trade whichever time frame you want to trade, it is very important to trade smaller time frame buyers in alignment with bigger time frame buyers. So let's look at internal and external structure in 1 minute using this 4 hours illustration right here. So we have this 4 hours downtrend as our external structure, as our swing structure, and then I want to look within here. I am seeing something that looks like a smaller time frame. I'm seeing something that looks like smaller time frame bullish structures formed up within here. So what I'll do now is I'll switch to, this is the 4 hours chart. we have identified this high lows as the 4 hours structure, which is the external structure. Now I'll go to the 30-minute structure. Let's see what we have in there in the 30 minutes. Now on the 30 minutes, okay, yes, rightly we have a perfect bullish structure on the 30 minutes right here. Now you would see that on the 4 hours the trend is a downtrend. On the 30 minutes the trend right here is an uptrend. Why multiple time frame analysis is important is, for me, it would be quite detrimental to be holding a very strong bullish bias within this 30-minute price range, within this 30-minute price action, if you are looking to ride that bias long term. So if I have a 30-minute bias, bullish bias, and let's say I'm buying here with the intention of selling here and then getting out of the trade, that is not a very wrong one. But if I am looking to buy in here with the intention of riding up until above here, knowing fully well that the 4-hour structure is a bearish structure, then that is a counter bias. It is more likely that that bias is going to get invalidated. So internal structures are smaller time frame structures forming up within the overall trend, while external structures is the prevailing time frame market structure basically. Now next, very importantly, I think this is where we would most likely be looking to round off this, is let's look at supply and demand trading, because supply and demand is very important. By my basis, is one of the most important concepts that you can grasp in trading, and it is important because supply and demand, forces of supply and demand, are the invisible hand that moves the market in any direction. It doesn't really matter if you are looking to move the market in a bullish direction, in a bearish direction. What moves price in the market is the invisible hand of support of supply and demand. So in the next 5-10 minutes, let's look at what the concept of supply and demand is, as well as how to identify these levels of supply and demand in your price chart. So basically, like the name implies, supply basically means to make available. Basically, that is what supply means. In the most basic layman sense, supply means to make available, while demand means to request for availability. So in an economic sense now, supply basically means to sell, yes, to make available. And since we are talking economies, there are no freebies in a free market economy. So since we are looking economy, supply basically means to make available by means of selling, while demand means to buy, to pick up by means of buying, to request by means of buying. So supply is the willingness to sell, demand is the willingness to buy. And a supply market is one that is defined by sellers, while a demand market is one that is defined by buyers. If you understand, if you wrapped your head around seasonalities, you would understand that you notice that there are certain economic goods that in a particular season they are vastly available, and because of this huge availability, the prices are usually forced downward. So let me use I'll try and look for something that almost everyone can relate to it. It doesn't really matter what part of the world you're from. If you are on this planet that I am on, then occasionally you experience seasonal change. Like I'm talking weather seasonal change. In this part of the world, we go from wet seasons to dry seasons and then back to wet seasons. It's similar in other parts of the world, from wet seasons to dry seasons. And usually in wet seasons, planting take place. In dry season, harvesting take place. Now, because in wet seasons, planting is what takes place. It means that most most agricultural products are usually not available for consumption that period. They are usually not available for consumption. They are maybe available for planting or for other things, but they are not available. They are not necessarily available for consumption during that period. And what this causes is, because you have more people that are willing to buy, that is a period you have consumption. You are still maintaining consumption because population is not reducing. Population is either growing or constant. And if those people are still alive, it means that they are going to eat. And they are going to eat in a season where supply, the availability of that product has reduced, because it is not an harvesting period. It is a period where whatever it is that you have is supposed to be put in the ground. So demand is constant or increasing while supply is reducing. And in normal economic sense, in a demand market, in a market where you have more people that are willing to buy than sell, prices is likely to go up. Now, what usually, every time I studied this in school, I studied this, and this is taught in the traditional sense. It is just taught on the basis of all things being equal. The higher the demand, the higher the price of a commodity. I will go a bit further to explain what really happens that causes that law of demand to hold, because it is a law, but it is a law that only holds because other variables are in place. Now, I'm still going to go back to this reference that I have pointed earlier, a reference of we are looking at agricultural based products on the basis of seasons of planting and harvesting. Now, in the season of planting, demand is usually high because, like I have stated, population is constant and they have to eat, and they will request for what they will eat. And since in that season we are not getting harvests from the market, we are getting shortage of supply. What it is going to cost, what causes price to go up in a demand market? It is not just the fact that you have more willing buy. It is the competition between buyers that causes price to go up. If you've ever attended an auction, I've never been in one, but I've seen a couple of them on movies. If you've ever attended an auction, this is the best case that explains what I am saying. If you've ever attended an auction, what happens in an auction is you have one item, let's say a car or a laptop or a tuber of yam on the auction floor, and then you have, let's say, 30 buyers seated or 40 buyers seated or 50 buyers seated asking for that one item. Now, as the auction begins to proceed, you will discover that the price that is put, the fair value that is placed on that item gradually begins to go up. But what causes that price to go up is not just the fact that you have one item on the table and 50 people seated in front of it. It is the fact that the buyers are constantly competing within themselves for a limited resources. It is the competition between buyers in a demand market that move prices up. It is the competition between sellers in a supply market that pushes prices down. It is not necessarily the availability of buyers, because if we have 1,000 buyers seated right here and then we have one item for an auction and none of those 1,000 buyers are willing to buy that item, we are going to have the item at exactly the price that it was first stated as. So if it was first called at $50, it is going to remain at $50 because nobody is willing to buy it. It is the competition between me and you and the next person beside you that causes price to go up. It is the competition of me saying that, okay, we are in a season where grains are not in the market because this is a planting season and we only have one bag of grain in the market today. If I am not early enough in the market, someone else is going to buy that one bag of grain. So it is the competition between me and that someone else that causes the seller to say, now I have 3 people that wants to buy my bag of grain. I am going to sell it to the best. I'm going to sell it to the best bidder or at the best price that it is asked for. Simple. So that is what moves price. It is not. It is a general concept. I studied this in school, and in school it is a very, very narrow one way of approaching it, which is the assumption that all things being equal in a demand market, prices will go up. All things being equal. One, all things can never be equal because this is a economics. We are looking at a market, and the participants of that market are human beings, so you cannot expect things to be equal. You just have to understand the idea behind that price movement, which is the competition between buyers as well as the competition between sellers. Now, in a demand market and in a supply market, the levels, the areas that we have this concentration of buyers and sellers can usually be identified on your price chart. It can usually be identified on your price chart because, like we have stated, what moves price is the competition between buyers. So Bitcoin is at $100,000. It dropped from $100,000 to $70,000. And a lot of buyers believes that $70,000 is a good support level for Bitcoin, and they place their order on $70,000. Now, because of this high volume, this increased market orders on a particular price range, you can usually identify on your price chart that level where you have increased market order, increased market activities, either buying or selling activities going on. And there are 4 ways, there are 4 structures that traders have identified in an attempt to identify levels of supply and levels of demand in the market. Now, these 4 structures are rally-based rally, drop-based rally, drop-based rally-based rally, drop-based rally, rally-based drop, rally-based drop, drop-based rally. We are going to look at the 4 of them quickly, although personally I only focus on 2 of those, and I'll explain that very quickly. Now, let me illustrate this before we start to look at it on the price chart. I'm illustrating this with a line, but assume my line to be candlesticks formation. I'm not going to illustrate it on candlesticks. I'll pick that out from the price chart. I'll just illustrate it with a line chart. Now, we have the rally, base rally. That's 1. We have the drop, base rally. Okay, that's 2. And then we have the rally base drop, rally base drop. And then we have the drop base rally. Drop, base, and rally. Now, if you've listened to me, one thing is common with all of these 4, which is the base. The base is the one thing that is common with each of these. I'll still explain this a bit further. The base right here, and then the base right here. So I'll explain the base. The base basically is smaller sideways price action. Usually that is where we want to identify as our supply or demand zone. Now, rally base rally is either in the case of a supply market or a supply structure or a demand structure in the market. Usually supply and demand are identified with 3 or more candlestick formation in the market. 3 or more candlestick formation in the market. Now I say 3 or more because your base can be a 1 candlestick formation or more than a 1 candlestick formation. So your rally based rally is a market formation where you have the rally being a bullish candle, the base being a smaller sideways candle. So it can be a bullish candle, a bearish candle. It doesn't really matter. What matters is your base should be a smaller candle. Considering the strength of this impulse, you would usually have a smaller candle as your base. So rally base and then a rally which is another stronger bullish candle. And usually the base will be identified as your demand zone for price to drop into. Okay, let me I will illustrate this. I'll move this to this point and then I'll move this to this point. Yes, let me use this to explain it. We'll get there. Okay, so usually, and this will explain why I only trade 2 of the 4 supply and demand market structures that are out there. Now, usually when you have a rally based rally, what supply and demand traders look forward to is prices pulling back into this area that has been identified as the base for them to fill their buy order in continuation of the uptrend. So usually you have rally based rally as a bullish formation, and then you have drop based rally as another bullish formation. Now drop based rally comprises the same. It's a 3 or more candlestick formation, which the drop is a bearish candle, the base is a smaller sideways price action, while the rally is a strong bullish candle. Drop based rally. And for me, I only trade supply and demand in this fashion of rally based rally being the only and drop based rally being the only structures that I look forward to trading. Why? Let me we'll get the illustration. Okay, yes, let me illustrate it this way. So for me, I only look at rally based rally and drop based drop. Drop based drop as well is a 3 or more candlestick formation, the drop being a bearish candle, the base being smaller sideways price action, and then followed by another strong bearish candle. While the rally based drop is rally a bullish candle, the base can be bullish or bearish, it doesn't really matter, it's just smaller sideways price action, and then a drop which is a bearish candle. Now rally based rally and drop based rally are bullish candlestick formations, while drop based rally and rally based drop are bearish candlestick formation. But I for one only pays emphasis on rally based rally and drop based drop, simply because the aim of supply and demand trading is supposed to be to identify those price range in the market where you have increased presence of buyers and sellers. Basically, what we are looking forward is that area where we have increased liquidity, increased buying or selling activities readily going on, basically. So for me, rally based rally shows level of liquidity, shows area of values on your price chart, while drop based rally and rally based drop are supply and demand structures that only forms up to take out liquidity, to test the validity of a rally based rally or drop based drop. So if I am looking forward to a level where I'm expecting price to react and move, I am looking for rally based rally or drop based drop. Now if I am looking for structures and formations to confirm the test, my bias of this value of this range as a supply range of as a supply zone and this as a demand zone. I want to see demand structures of drop based rally and rally based drop forming up within that zone. So for me, if I am looking at my area of value to either buy or sell, I am only looking at rally based rally and drop based drop, while looking forward to seeing drop based rally and rally based drop moving into those range. Yes, so that's basically it for, I think that best explains the theory and structural outlook of supply and demand. Now in the next 5 minutes, I will look to identify these structures in the market, and I think that's where we'll call it a close for today. Okay, so very quickly, let me look for where we can find levels of demand and supply in the market: rally based rally and drop based rally. Okay, you will see we have a rally based rally, price testing it smally. I'm not going to go into too much details. You will figure this out on your own when you're looking at the market. For me, this is an illustration. This is a demonstration of what we've learned up until this point. So here we have a rally, a strong bullish candle, and we have a smaller bullish candle to the side, followed by another bullish candle. You can see price coming in, testing this, moving up slightly, and then coming back down. I think I should go back to the 4 hours time frame. Let's use a much bigger time frame and see. Okay, here you can see price. We have a rally based rally, and then you can see price dropping to test it, going back up, coming back down to test it, and then moving in that direction. Here we have a drop based rally, and you can see in this case we have a drop, a bearish candle. We have two base candle, a bullish and a bearish candle, and then a strong impulse to the downside. I will highlight that as my supply zone for the purpose of this video. And you can see price rallying into it, getting rejected, and then pushing back down. You can see almost the same thing here: a drop, a base, a drop. If you draw that out, this came to test it, this came to test, this came to test. We can still go a bit further. If I mark out this to be, I'll just try and see if we can identify one or two more supply and demand structure in the market. I would like to quickly state that I am no longer a purely supply and demand trader. I started off as a supply and demand trader, trading only supply and demand for about 3 or more years before figuring out why supply and demand doesn't work for most people. So I am no longer a supply and demand trader. Yes, I'm no longer a supply and demand trader. I trade the caveman method, which hopefully in the course of this training I'll be able to make available in PDF file format. Now here you can see we have a drop based drop supply, and then you can see that is basically what started the entirety of this downtrend that we are seeing down here. Let me see something. If we have a demand down here, now you can see right here we have a rally based rally, and this. There are other concepts of supply and demand that I have figured out for myself in my course of being in this market. I think there are hidden zones, that hidden supply or demand zones, which are basically smaller time frame supply and demand zone that get respected. They are smaller time frame zones, but they get respected. Now you can see this demand getting respected, this supply getting respected, this supply getting respected, this demand getting respected. That is it for that is basically it. Now when coming to how to mark out supply or demand zones, there's a bit of argument how to mark out supply and demand. For me, I mark out supply and demand from week to week of the base candle. So from the high to the low of the base candle is where how I mark out supply and demand zones. I have seen a couple of other traders that only mark out from open and close of the base candle. It doesn't really matter. Whatever works best for you, you will figure out in the market. So that's it with supply and demand. There are other concepts of supply and demand like the flip zones. Flip zones are basically supply and demand zones and structures that you will find along break of structures. So you have a support, market break the supports, and that support becomes resistance. Along that new resistance level, if you would find a supply zone along there, that is what is usually referred to as a flip zone. The concept is quite a broad concept, but for me, that is how I approach the idea of a flip zone. Is supply and demand levels that are supply and demand structures that are at the break of a particular price level in the market. That is how I identify flip zones. Now, some other traders identify supply and demand flip zones as when a supply or a demand gets broken, gets invalidated, it flips row. That is how some people define flip zones in trading. Is a zone that flips row. It used to serve as support, it gets broken, it has now changed row to resistance. And in supply and demand, it is looked at as it used to serve as supply, or it used to serve as the demand zone in the market. It is now broken, it is now supply. I don't really approach supply and demand from the concept of supply becoming demand or demand becoming supply, unless I can actually identify a price range where a supply was broken, and then now we have demand liquidity forming up along that range. So guys, that is basically it for we've covered the most part of the 40 days trading for dummy series. Now tomorrow we are going to be looking at the non-technical aspects of making your technical analysis work. I'll see you guys in tomorrow's live stream as well as in the next video. I remain Monaco Daniel, the mastermind trader from the world's most populous black nation.